stock of KPIT Tech is down in today's trade by around 4 to 5%. And the reason is the mid-quarter update that the company has given. Now, the quarter update says that the overall deal pipeline in the European business is strong, but in the US and Asia, the outlook remains actually weak and uncertain. Also, the deal conversion timelines that remains a little big, elongated, and also much slower than expected. The revenue conversion from closed deal have progressed at a lower pace than what was earlier expected. Also, the company says that they expect the cash of acquisition to close by the quarter end, and they anticipate the deal completion will actually contribute 4% growth to FY26 versus FY25. Now, Kotak has a sell on this stock with a price target of 1,000 rupees. They have actually cut their FY26 to 28 earnings estimate by around 3 to 4% and also trimmed down their FY26 organic revenue growth to 7% versus 9% earlier. They do not bake in the revenue contribution from cash of acquisition because they are waiting the overall closure of this deal. And also they have moderated the EBITDA margin estimate by around 30 basis points from FY26 to FY28. They say that the overall deal pipeline is strong, but the decision-making delays actually is impacting the overall bookings for this company. Also, the demand trends are weak and there is limited recovery expected in FY26, and hence they have actually cut their overall earnings estimate. So it's an earnings estimate cut by Kotak and also the overall muted mid-quarter update by KPIT Tech that has resulted in the fall of stock price in KPIT Tech in today's trading session.
Thank you so much for all of those details, Varun. So clearly a brokerage downgrade and all the reasons behind a dent of around 5.5% in KPIT Technologies. But now let us understand the sector a bit more, and joins with us is Sandip Agarwal, Fund Manager, Sowilo Investment Manager, will talk to us in detail about the IT sector. Global connects impacting the space, but domestic IT again has its own style of moving. Sandip, good afternoon. Thank you so much for joining with us. Uncertain demand, deal conversion on the face of it are a few parameters which are concerns for the IT sector. But other than that, also the AI adoption is accelerating. Net employee addition is muted. The larger IT players are showing signs of concerns. However, the mid-cap IT again is showing some momentum. What is your overall take on the IT sector?
Yeah, hi, good afternoon, and thanks for having me on the show. So, as you rightly mentioned, that the biggest thing which is weighing on, and we have seen with a superb number for Accenture and even, technical upgrade in the guidance, still the stock took a beating because primarily, people are more concerned about how the future looks like. And the challenge is that Accenture has not only said that they see the uncertainty in near term, but they also said that they are seeing uncertainty in the longer term, basically CY25. So now if there is uncertainty for full of CY25, it means the next year guidance will be also weak, and also, it lingers on Indian IT space. So I think the challenge is that uncertainty plus, people want to only spend on what is mandatory during such times. Additionally, this AI thing, people are very confused that, how much efforts could be actually cut down. So they are delaying spends, which is discretionary in nature.
All right, but Sandeep, also give us some sense on the valuations, because till date we have seen that because of the higher growth, all these mid-tier IT companies used to hold a higher premium and valuation. But now that we are seeing commentary coming in from KPIT Tech, even Accenture outlook was not that great. Do you believe that these companies will still hold those higher valuations, or maybe it's time for the valuations to recorrect and get closer to the large cap names?
So, all these companies post-COVID have done phenomenally well because their growth rates were quite good and because their sizes were small. So all the new demand which came from the digital side that popped up the stocks, valuations and the earnings and everything. I think now there is little normalization, although I still believe that, we have to see a very difficult combination of three things. That is, the market size of the company, the technology in which they operate, and the segments in which they are, basically the industry. So problem is that, we are seeing challenges in the manufacturing side, primarily in the European geography, in the auto side. And all this, wherever these combinations are there are a lot of pain. And as you rightly said, the stocks are not cheap. They have run up quite a bit. So, we will see either time correction or price correction. I am not comfortable with most of the stocks at current multiples because the PEG ratios run from 3 to 5. Which is very, very high. How can you surprise from here? It's very difficult.
Absolutely. I second the thought, Sandeep. A sector which is connected with the global concerns, IT sector, and that's the reason we see a lot of concerns. Thank you so much, Sandeep, for all the analysis on the IT sector and helping us navigate through the sector and the reasons behind it. Moving on.